I'll pass the proverbial microphone over to the Innovation Center Director, Grace Chu, to properly introduce our guest, Ryan Spiers from Cooley LLP.
Thank you, Crystal. Good afternoon, everyone. I'm Grace Chu. Welcome to the first of our 2021 speaker series. Reno continued to grow in our entrepreneurial ecosystem. We often get questions from entrepreneurs, both from the community as well as from the university, asking about legal entity issues. Setting up the right legal entity is perhaps one of the most important things you need to consider as you start your new business. So today we're very fortunate to have an attorney from Cooley, Ryan Spiers, to talk to us and maybe clarify some misconceptions and some of the do's and don'ts. For those of you that are not familiar with Cooley, it's a top tier firm based in San Francisco with offices throughout the United States, as well as Europe and Asia. Cooley is often known as the #1 company for technology and life sciences IPO. Ryan himself has done a number of IPOs, mergers, acquisitions, helping clients do venture financing. So again, we're very fortunate to have Ryan to tell us various issues about legal entity. Now, throughout his presentation, if you have any questions, please put them in the chat room and we'll try to address your question. And Ryan, without further ado, I'll give you the mic and you can say a little bit about Cooley and before jumping into your presentation.
You bet. Actually, I'm gonna pop up my slide deck because it has a couple of fancy accolades listed there that'll let everybody know. So Cooley is in fact an international law firm. It's a big one. We are voted regularly the best law firm for venture capital financings and for startups in general. We do almost more venture capital financings than anyone else. Many years we do more than any other firm. I myself have formed easily over 100 companies. I've represented investors and companies in an aggregate of at least 500 venture financings. I've done IPOs, I do mergers. And that's my practice. I work with companies from the smallest, earliest possible stage when you've got a guy in a garage or a woman in a garage, anyone in a garage, really, as long as it's a garage, I can be there, up through big public companies. For a long time in my practice, I did public company reporting. So I've done that as well. Really, we try to be a full spectrum law firm that can do everything. And I've tried to model my practice after that. We'll get right into it. So as Grace said, the big question is, what entity should we choose? Let me just pull up so I can make sure I can see the chat. So as questions come in. Oh, that should do it. Perfect. Okay. So do you need an entity to form a company? Is that something that you actually need to do? The answer is yes, you do, more often than not. And so what happens if you don't form an entity versus if you do? In my pretty little red circle here, I've circled two types, a sole proprietorship or a partnership. If you don't do anything, if you just start working as a business, you will fall into one of these two categories. If you're alone, you're a sole proprietor. If you're with someone, you're a partnership. The problem with either of those entities is there's no limitation on your liability. So if you do something wrong, or if you do anything that causes you to be sued, your personal assets will be attached to that. So there's nothing to protect you and your personal assets. There's also nothing necessarily, unless you've entered into a separate agreement legally, that would define how that entity or how what you're doing is managed. Also, the taxes will just come directly to you. That's just the way it will work. So what are your alternatives? You can form an LLC, a corporation, or some form of limited partnership. We're not really going to talk much about an S Corp or about a limited partnership, mostly because they're just not good choices for what I think most of you want to do. So then what is the right choice? Sorry, I lost my comments again. Give me just one moment. There we go. So, should you form an LLC? An LLC can have one or more owners. It is managed either by the members, meaning everyone who holds the interests in the LLC, or it's managed by the managers, who are a specifically defined set of groups, a group of people who are in charge of the LLC. It has far fewer legal formalities than a C Corp. You can really do with an LLC almost anything you want to do. You can structure it however you want with whatever formalities you'd like to build in. A C corporation, on the other hand, is a much more formal entity. You can have an unlimited number of shareholders. The way in which you own those shares and the rights of a shareholder are far more specifically designated by law. It's typically managed by a board of directors. It, just like a limited liability company, does limit your liability. It's easy to expand, but on the downside, it doesn't have the option for pass-through taxation, which we'll talk about in just a minute. Just so we've mentioned them, and so that I cannot talk about them again for the rest of the presentation. A limited partnership is at least two people doing business together as a single entity, one of whom is a passive or limited partner. The other is in charge of the management of the partnership and is a general partner. The partner, the general partner, has liability, whereas the limited partner has no liability. This is a very common structure for law firms and for venture capital funds and for other investment vehicles. You don't want one unless you're one of those two or three things. An S corporation is a C corporation, except that it's elected for tax purposes to be taxed as a partnership. Again, we'll talk about pass-through taxation in a moment, but by virtue of electing that, it comes with additional restrictions on what you can and can't do. If you're an S corporation, you can have no more than 100 shareholders. Your shareholders, with few exceptions, have to be natural persons. And it's otherwise functions very much like a corporation. The reason I don't recommend S corps, other than these restrictions, is that everything that an S corp can do, an LLC can do better. So there's really no reason to form an S corporation. We'll talk briefly a little bit later as well about converting from an LLC to a corporation. And it is easier to convert from an S corp to a C corp, but the things you lose in forming the S corp don't make it worth it. My slides are not going to have any fun images. I'd hope to have comics and jokes and things built in, but I don't. I apologize. So again, limited partnerships, you probably don't want. They're very specialized. A C corp, I would recommend for almost anyone, unless you're going to be running the business on your own with one or two people, and you intend to manage that business going forward without bringing in many investors, if any. And if you specifically have an intent of taking revenue from that business and having it directly come to you. And again, an S corp has some tax benefits, but its limitations make it really not a feasible choice for most people. So what does the limited liability mean? Some of the comments here will be a little bit on the lighter side, more of an overview, and some will be a little more specific. This is more of an introduction slide here. Limited liability means that if you get sued, if the company gets sued, you are not liable for those losses. It's as simple as that. The problem is that you only can have that if you respect the corporate formalities associated with your entity. If at any point you commingle assets, for example, and you use the company's bank account as your own, you withdraw it to pay for personal expenses, and you don't record it as a distribution to you as an individual, or you do other things such as not formally having your decisions that are taken by the corporation approved by a board of directors, for example, or if there are other actions the LLC would take, but you sign them in your own name, not in the name of the LLC. And in general, just disregard that the entity is there, then you will have forfeited that protection that you would otherwise have by law. So don't commingle assets and follow the rules. If you do those two things, you will keep your assets protected by virtue of having formed your entity and done things right. So as you keep your business and personal assets separate, you can protect yourself significantly there. Insurance is always a good idea. It's always a good idea. If you are going to be operating as a business and there's a chance that someone could be injured or that your assets could be lost, having an insurance policy is really a great way to offset those expenses when something does go wrong. As a lawyer, my job is to assume that everything does and will go wrong. So it will. Something will go wrong. So to dig in on a little more detail then, do you want a C corporation or do you want an LLC? Let's put together a little sample company here, and we'll talk through it together. So let's say I am going to start a company because I have this great idea where I think the world really needs the ability to buy shoes for dogs and have them delivered to their homes. There's really nothing better that could possibly happen for the world than designer dog shoes, preferably with heels. Do I want a C corporation or do I want a limited liability company? Well, I know that there's a chance that a dog could get hurt, so I need limited liability. So I definitely need an entity so that if I injure someone's dog by virtue of them all wearing my dog high heels, I'm safe. Now, I think I have the greatest idea in the world, and I'm going to go seek outside investment. So in seeking outside investment, I think I'm going to bring on some big time investors. I think Silicon Valley is going to eat my idea up and I'm going to win. So flow through taxation, while I would love that, may not actually make any sense for me because investors in Silicon Valley and any investor whose major investors in their fund include pensions or other trusts that are tax-free will not be able to take investments from an LLC because of the restrictions of that flow through taxation. So I actually don't want flow through taxation. If, however, I think that, you know what, I'm just going to sell them to the people in my neighborhood and I just want to be able to use those taxes and those losses because I'm going to lose money for a year or two while I figure things out. I can use those passive loss deductions on my own taxes up to $25,000 with a phase out over $100,000 of AGI. And I think I might use those. Then I would consider an LLC. But for me and my great idea here, we're going to go with investors. So I'm going to say I don't care about flow through taxation. I'd like it to be low cost because I don't have a lot of money to start it. So I'm going to do. Okay, special allocations. Am I worried about having to allocate any individual people working with me? Not really. Do I need tax-free in-kind distributions? This is the ability to take, again, assets that come into the entity and distribute them to the shareholders or the members directly without taxation. It's not going to work with a corporation, but I'm not worried because I'm going to make $1 bazillion on my great idea. Qualified small business stock is a great deal for anyone who's investing in small business. What it says is that if you hold your stock for 5 years and you adhere to the rules set forth in the tax code, then up to $10 million of the gain on your shares will be tax-free. This is a great asset for the founders of the company, but also for the investors who are putting their money in early on. So I'd like that, and I can't get that if I'm in an LLC. There are no limitations on capital structure. Again, I can sell my assets to anybody. Unrelated business taxable income for tax-exempt investors. Again, I think I'm going to raise money in Silicon Valley, so I want to be able to do that, and so I don't want an LLC. I'm definitely going to go public as soon as possible with my dog shoes, so I'd want a C corporation. Can a limited liability company go public? Sure, it's possible, but it's very rare. As you'll note in footnote C, if you do go public, you lose tax flow, you lose your pass flow taxation. And that's the primary benefit of why you wanted to be an LLC to begin with. Now, I don't have as much flexibility in my documents as I draft them, but I think I'll be okay because I'm not trying to do anything really crazy between me and a co-founder. The rest of these are essentially the same thing. There's tax-free corporate acquisition provisions that help me if I'm a corporation. So when I go to sell it for millions of dollars, there are ways I can do that that reduce my tax burden. I'm going to hire lots of employees to manufacture my shoes. And as I do that, I'm going to want to give them stock options. Stock options for limited liability companies are very complicated and not worth the time and expense of doing them because they'll be structured in a way that most employees really won't understand. It won't be a simple tax, won't be a simple stock option. Now, undistributed earnings. So as I take in earnings into an LLC, I will be taxed on those, again, because everything flows through. So if I have earnings at the LLC level, those earnings have to be passed through to the individuals. So as I pay those taxes, I get a step up in my taxable basis if I'm in an LLC. As you can see, if it was an individual running a business like a gardening company, that would be hugely beneficial to me. I wouldn't be paying taxes twice to get money out. So I would definitely prefer an LLC. But because I'm going to go make $1 billion and go public on NASDAQ, I don't need to worry about that with my dog shoe company. So I'm going to stop there for a second because I still don't know if I'm seeing any comments. Does anybody have any questions about the taxation or the general expenses of picking between a C Corp and an LLC?
Yeah, Ryan, so there's a question about conversion from LLC to C Corp, which I believe you might cover at a later date, at a later time. But we have faculty members generally trying to go after SBIR, STTR grant, and they form an LLC. But later on, when they go seek venture financing, they need a C Corp. You can either answer the question now, or we can wait till when you address that topic.
No, let's talk about it now. So if I form an LLC now because I want to be able to take advantage of those tax benefits in the short term, and I think I might be pulling some money out, or simply because I think it'll be easier, I would argue it's not, but if I think it might be, maybe I'll form an LLC. What happens when I convert? Well, if you are the sole member, then approvals are not a problem. You just get your own approval and you can exchange you can either convert or you can do a merger. If you convert, most formal codes, you would typically go to Delaware from Nevada, or if you're within Delaware or within Nevada, there's a conversion option, which simply takes all of the business of the LLC and converts it into a C Corp. Everything stays the same, nothing changes. If you want to do the merger, it's the same thing, except you're exchanging all of the assets, all of the stock, you're exchanging them for shares of the corporation. What happens at that time? What have you gained? What have you lost? If you convert versus just forming initially, there is going to be a legal expense. The cost of doing it correctly and ensuring that when someone looks at it down the road, again, if you're going to go for investors, making sure it's done correctly, you'll want to engage competent counsel, and it will cost probably at least, I would assume, $15,000 to $30,000 to convert it. So there's a legal cost. Also, you'll recall I talked briefly about qualified small business stock. That works only for a corporation, obviously, and that clock won't start ticking until you do the conversion. So if you go out for an SBIR grant, and it's going to take you a year or maybe 2 to do that, you could have already started that 5-year clock ticking by having formed a corporation initially. Otherwise, there's not a lot of legal impacts. They're mostly tax impacts. It's more efficient in the long run to have formed a corporation to begin with. If you form an LLC and flip to a corporation, you simply defer the time at which you can start taking benefits of both the qualified small business stock, but also small business corporations, so SBCs, also get a 50% reduction in their taxation on the gain on the back end. Same 5-year holding window. Also, in some cases, you're not allowed to tack your long-term capital gains holding on those shares for LLC versus C Corp. So in general, if you think you're going to sell your company or you're going to go public, assume you're going to sell it. Don't assume you're going to go public. If you assume you're going to sell the shares of your stock at some point, and that's how you're going to make lots of money, just start with a corporation. You will start all of the benefits that you can have on the back end when you sell it. The earlier you start those, the happier you'll be. See another comment here.
Ryan, so there's another question about the LLC structure. So this kind of question we actually get a lot. So one reason for LLC structure may be that if a 51% owner may be a service-connected disabled veteran, such an LLC may have advantages for SBA loans and government contracts. And would a C Corp be able to take advantage of that?
So unfortunately, I'm not an expert in SBA loan grant rules, so I can't affirmatively say one way or the other. But I would argue that if it's 51% held by an LLC, the same would be available for a corporation. I would be shocked if it wasn't. If it's more than 51% held, there's not a lot of a difference between the two. There are certain benefits to being a single member LLC, as the entity can simply be disregarded for most purposes. And in those cases, there are some benefits to being an LLC. But so let's take an example. I think the next question here is, let's say you get a grant, and that's going to come in as income to the entity, and you're going to then need to do something with it. Depending on how the grant is taxed, oftentimes grants are tax-free, so you don't need to worry about it. But let's say instead of 500K from a grant, let's say it's 500K in revenue. You get this great deal. Walmart agrees to sell my dog shoes. So I'm forming my entity. They say, oh, we will pay you $500,000 to be your exclusive distributor on the West Coast. I say, that's great, I'm in. $500,000 then comes into Dog Shoe Co. Either, if that's a corporation, it sits there and you'll have to pay corporate taxes on it. You can obviously then within the ledger, you'll offset revenue that comes in against expenses paid, and how much your profits are will actually determine how you're taxed. And the same process will work at an LLC. You'll take profits and losses, or revenue versus expenses, and you'll equalize them out. But let's say at the end of the day, I have $100,000 in gain in profits at the end of the year. If I'm a corporation, that gets taxed at the corporate level. I have to pay federal corporate taxes and any state corporate taxes that may apply. Nevada thankfully has none. If I'm an LLC, that gain passes through to me as an individual, as the owner. If there are two members, it passes through equally, or however you have it divided up, to the members of the LLC. They then have to take that on their personal income taxes. Typically, an operating agreement will have a provision that governs tax distributions to help get cash out of the LLC to cover tax costs, assuming there's cash in the LLC to pay them. So, does it matter? If I'm in that corporation and I want that $100,000 that's left over to come to me, and I don't want to leave it in the company to keep building the company, then if the corporation pays a dividend to me, I have to pay dividend taxes. If it pays it to me as salary, I have to pay personal income taxes. There's double taxation in a corporation. Whereas in the LLC, you're paying taxes directly either way. So there's no separate layer of tax, which is why if you're a gardener, it makes zero sense to have a corporation in most cases, because you'd be paying tax twice to get the money out of the business, unless you're paying yourself a big salary. Does that make sense? I hope. And we'll have a slide on that in just a second. A hot button topic, and please keep questions coming. It's very helpful for me to know what you actually want to know. A hot button topic I keep hearing now that I've moved to Reno is, should I form in Delaware or should I form in Nevada? I love Nevada. I'm now barred in Nevada. Home means Nevada, but you should just form in Delaware. Delaware is really the gold standard for corporate law. The Court of Chancery in Delaware is widely thought of and widely viewed as the most sophisticated court in the land for resolving business issues. It's by far the most common choice among all startups. And the reason for that, in part, is because you can predict and rely, and investors can predict, and you, as you're entering into a business arrangement, you can foresee realistically and reliably what the outcome of a lawsuit will be on the back end. Nevada is at least as liberal as Delaware with its corporate law, which is very nice. That's not the same in California, where I spent the first half of my practice. California is far more protective of the individual than it is the business. Nevada is equally protective, if not more so, than Delaware. In some ways, it's more protective for business owners, largely in the differences in the ways in which you can waive fiduciary duties. Courts in Nevada typically follow Delaware precedent and are relatively reliable. They just haven't seen as many cases. Also in Nevada, you obviously have the benefit of no state or corporate income tax, personal income tax. Now, I often hear, isn't Delaware so expensive? You've got franchise taxes, you've got filing fees. When compared to Nevada, it's kind of a wash. It can be a little more, it can be a little less. I have a link at the end of my presentation you can use if you have a Delaware corporation and you're filing franchise taxes. Never pay the bill they send you. There are alternative ways to calculate that will reduce your tax dramatically, especially if you formed your entity correctly. But in Nevada, there are business license fees. And when you put them side by side for a small business, it's really a wash. It's more or less the same expense. Sometimes Nevada's a little more, sometimes Delaware's a little more. So I wouldn't consider filing fees to really be a reason to not form in Delaware. If there's a reason to form in Nevada, like you need to have a Nevada corporation to be eligible for certain grants or for certain tax provisions, then by all means, Nevada is a wonderful place to incorporate. And I see people doing it all the time. But by and large, by far, if you're going to go get venture capital funding, just incorporate in Delaware. It's the right thing to do. And then I won't have to convert you later on, which is just another, as I said, roughly the same expense of converting from an LLC to a C Corp. It's the same if you need to reincorporate from Nevada to Delaware. So we've selected an entity one way or the other. Now, what do? We obviously want people to own some portion of it. We want stock, we want whatever we have. What does that look like? What should we think about? So at the very most basic level, an LLC is managed by its members or by managers. An LLC when you form an LLC, there are two documents. You'll have a document that you file with the state that says, I'm forming an LLC, it will exist, this is its name. That's really all it says. You'll then have an operating agreement, which is a lengthy agreement. Essentially, you can think of it like a contract that determines how everyone's going to treat each other. That's really all an LLC is. But that operating agreement can be very complex. It can have just as much formality as a corporation. A corporation is managed by its board of directors. It's stipulated by law, that's who manages it. Stockholders have certain rights as well, but the day-to-day operations are managed by management, who is governed by the board of directors, who are reportable to the shareholders. It's all very structured, and it's very simple, both in adding new stockholders and in adding and managing the board of directors. There are no mandatory meetings for an LLC, which is nice. It's really just a shell company. It can be whatever you want it to be. You can make of it what you will. A corporation, however, typically by law says, the law reads, there is an annual meeting of the shareholders, and there are regular meetings of the board of directors. In some ways, and sometimes people worry about this and think, oh, well, I need to form an LLC. I don't want to have meetings with my shareholders annually. I don't want to hold regular board meetings. In practice, almost no private companies hold an annual shareholders meeting. The penalty for not holding an annual shareholders meeting under law is typically, well, hold one when you can. Any decisions will be deferred until you hold it, unless they're taken by written consent. So there's no benefit in holding one other than being in touch with your shareholders more often. Similarly, if it's you formed a company, you form a board of directors of which you are the sole member, you don't need to have a meeting of yourself to discuss things. You're having them practically all the time because you're thinking about your business, you're managing a business. What it means is that if you're going to take an action that Delaware law or Nevada law says the board of directors needs to approve, you just need to have a piece of paper that says, I, as the sole director, approve this action. If you've done that, you have fulfilled your corporate formality requirements under Delaware or Nevada law, and you're fine. There's really no need to worry too much about the formalities involved. As you get larger, then you do need to make sure you're holding regular board meetings and that you're in touch generally with your stockholders and keeping them informed of what you're doing. That's more or less all it is. And all of those requirements will typically be imposed upon you by your shareholders as soon as you get sophisticated investors, because they'll want to know what's going on and they'll want to make sure that you're following corporate best practices for your corporate governance. Ooh, What decisions can the LLC owners and corporate shareholders do? So what is required? If you're going to sell the company, you have to get approval of either the majority of the members or a majority of the shareholders. Is that all? Well, it depends on what the operating agreement says. And for the corporation, it depends on what the certificate or articles of incorporation say. As you get more investors, they will demand more rights. Similarly, in Nevada, if you want to remove a director by a vote of the shareholders, you need at least a 2/3 vote of the shareholders to do so. That, in Delaware, you don't. You just need a majority vote to remove a director. There are other rights as well. If you take away certain shareholder rights or add certain shareholder rights, if you're going to amend one of the formative documents that are filed with the state, you'll have to get shareholder approval for those. Again, to what extent depends entirely upon what you've agreed to. We're going to come up in just a minute to talk about common stock and preferred stock, and we'll get to what I think is a much more exciting part, but we'll get there in a second. So, do you need a cap table? And what is a cap table? The answer is no matter what type of entity you have, yes, you need one. All that it is a list of who owns the stock in your company and in what amounts. That's really it. So you need to make sure you keep it current. You cannot effectively run your business if you don't know who owns it. 2, you got to keep it accurate. So you should have an Excel sheet, or you can use a service like Carta or ShareWorks, or there's a bunch of others. It should have the list of the name of the individual or the entity that owns the shares, the date on which they purchased them, the number of shares that they purchased, preferably also the price at which they issued them, because in 10 years, they're going to come back to you and they'll likely ask you what their basis is in their shares. And if you don't remember what price they paid, then you won't know. You want to know when they sold it, if it's no longer there. And then you'll want just any small comments that you need to keep track of. If somebody didn't pay all the way or somebody did something else, you want to make sure you keep track of that. Very simple, very easy. But if you don't have one, it will be a pain to dig back throughout your documents to determine who actually owns the company. So common stock or preferred stock? Well, common stock is what you're going to issue. When you form a company, you're going to issue common stock to yourself and to whoever your co-founders are. When you bring in investors, those investors will typically ask for rights that are senior to and that exceed the rights that you have as the founder of the company. That stock will be called preferred stock. There are certain rights that go along with that. One of the benefits of having it be sold as a separate series of stock, in fact, a separate class of stock, is that the price can be significantly higher without impacting what we deem to be the fair market value of your common stock. We'll come back in just a second to the next point there. Options or warrants. You may have all heard of warrants. Options are issued to employees. Warrants are issued to investors. All they are is a right to buy stock in the company at a future time at a price you've determined today. Incentive stock options versus non-incentive stock options. One of the other benefits of forming a corporation is that you can have the ability to issue equity incentive awards to your employees that have special tax-related provisions that make them more efficient on a tax basis. An incentive stock option, when it's granted, is tax-free. When it's exercised, it's still tax-free. When you sell the shares, you pay taxes. So you can effectively defer taxes until the time at which you actually sell the shares to someone else. A non-qualified stock option, or an NSO, is the same, except that when you exercise it, you're required to pay taxes on the spread. So the difference between the amount you're paying, i.e. the strike price, and the fair market value of the stock at that time. There are ridiculous amounts of arcane rules as to how that all functions, and all of the things you have to do to ensure that you comply with the rules that get you those beneficial treatment of options and don't get you into a place where you've underpriced your options and have penalties to pay. Just make sure you talk to a lawyer before you try to issue options. It's important. Okay, we'll come back to this one in just a second. So what about LLCs? LLCs do not permit you to issue options in the same way. They just don't. So you can't issue options to your employees without creating phantom awards that are not technically ownership interest in the entity. So what can you issue? You can issue membership interests, or you can refer to them as units, depending on whether or not you want to give someone a specific percentage or a number of units that equate to a percentage when you divide it by the total number of units outstanding. Why is it so hard to add stockholders to an LLC, to add members to an LLC? The reason is, one, remember that everything in an LLC flows through to its members. So if you add a member, that person is taking on tax liability. They're taking on the ability, you're allowing them to get a portion of the money that comes into the company on a regular basis if you're going to distribute anything from the entity. And they're becoming an equal member of the entity in that they'll have special votes and they'll have the same obligations to receive tax distributions and other things. Something else an LLC often does, again, a reason why it's useful as an investment structure, is it'll have a capital contribution requirement. Meaning if my LLC is running out of money and it needs more money, then we can build into our operating agreement that everyone agrees if we're running out of money, everybody puts in their pro rata amount of money to make sure that we keep going. So if you add a member, that member could be taking on a significant number of obligations for future capital contributions as well. So it's complicated, which is why it's easier to just have a corporation and issue stock where everybody knows what they're getting because it's very systematized. Okay, this question. Ooh, a hypothetical. Okay, first, grant example of PPP after forgiveness. Tax at the pass-through level of the member, a C corp treat as normal distribution. So if I take a PPP loan, ooh, this is a good one. Okay, so I take a PPP loan and I use it correctly and it's forgiven. So that income I took in is then forgiven. That is that forgiveness of the loan tax passed through to the member? Yes, in an LLC. To the extent there is tax due upon forgiveness of your PPP loan, that tax would pass through, assuming there are no other offsets to offset it, to the individual. If a C corp, it would not be treated as a distribution. It would simply be taxed at the corporate level. So the corporation would owe whatever taxes are due. And the funds for the payment of those taxes would come from the corporation. The individual stockholder is effectively separate from that. There's no capital contribution requirements. The entity is a freestanding entity. If the corporation can't pay us taxes, the corporation goes bankrupt. The individuals don't, if that makes sense. So there's no flow through of taxation or of profits or anything. It's like there's a firm wall below the C corp. Nothing comes through unless it's deemed to be a distribution. And that distribution is either a dividend or a return of capital. There's really no way to pass through losses to the stockholders of the company. A hypothetical from Stuart. Could a founder form a single member LLC and a C corp with shareholders? The LLC would go after SBR grants and government grants and develop IP patents, be assigned to the C corp with non-exclusive license, grant back to the LLC. Point being, the C corp could go after the angel VC funding while the LLC goes after government grants and contracts. Yes, you can. If I were to, so let's think about it this way. This is actually not that uncommon of a structure. If I'm advising my founders on their first time they're forming a company, and they're going to put their heart and soul into this company, and they're going to put a lot of sweat equity in. They may even put a substantial amount of cash into the company. But they have already done a lot of estate planning, and so they have a trust or they have an LLC. They'll often put the name of their stock into the entity by virtue of this other entity. So we have corporation, an LLC, or trust by the founders that put the money in. Similarly, when you take investment from an investor, 99% of the time, if they're a sophisticated investor, they're not going to put it in their own name. They're going to put it in via a entity, typically an LLC, if not a limited partnership. So Can you do this? Of course. The problem you're going to run into, and where it gets complicated, is investors don't love when the IP is not solely held by the corporation. So the license grant back can be sort of a hindrance on your future fundraising efforts. There's no reason you can't do it, but you can. But that can cause some problems. You also have to remember then that you're creating multiple entities and creating a complex tax structure, which is fine, but it's going to impose legal cost at each stage. You'll need to pay to form the LLC. You'll need to pay to form the corporation. You'll need to pay to cover any intercompany agreements. So if you have a wholly owned LLC that's doing operations, so we'll put context to it. I'm doing, or I did recently, an investment into an Israeli company for one of my funds. The Israeli company had all of its IP held in Israel in a holding company in Israel, but it had spun out a parent company in the US. So it had a US parent, but all the IP was still in Israel, meaning that the parent company in US that was the contracting agency, or the contracting company, when it sold its software in the US, it would sell it from the US company. It had to have a license to and from where the IP was in Israel. That transfer of IP is a taxable exchange. And so you have to have accountants come in and say, all right, what transfer tax is appropriate? Is it just cost plus 5%? Like, how much value is going back and forth? And how much taxes will I owe on that, even though it's a wholly owned LLC? So is it too complex? If you want to be nimble and keep it simple and keep your expenses low, yeah. If you're willing to pay the expenses and you have money coming in to manage those expenses, if you have strong investors or you're going to get a giant grant, sure, there's nothing we can't do from a legal perspective. But the rule of thumb, I think, that's helpful to keep in mind, the more simple the arrangement, the more simple your structure on your end, the lower your legal and accounting costs will be going forward. The more money you spend setting up your entity, assume that you will pay, the pain of that will linger, and you will pay it continually throughout the rest of the company's life cycle, just because it makes more accounting and legal expenses. So coming back around to some other exciting stuff, you have a co-founder. What should you do? Who should own what? How much should you own? Should you own more or less? What if you're putting in more know-how and they're putting in a little bit more money to get things going? How do you decide who owns what? You have to decide it from the beginning, and you need to write it down. I've seen lots of founders defer issuing their stock. They wait and say, well, we'll figure it out. Let's just get started and we'll figure out who owns the stock later. That is a kiss of death. Please, 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 please don't do that. Start your company and issue your stock. Should you include vesting? Yes. Yes, you should. Even if you don't think you need it. If you're going to go raise money from outside investors, if you have already put in place vesting means if I am granted stock from the company, 100 shares, and I impose 4 years of vesting on that stock, and I put a 1-year cliff on it, what that means is at the day one, I get all of my stock, but the company has the right to repurchase it from me if I leave the company at the price I paid for it. So I give them the money for the stock, which at formation will be a very low amount, typically par value. Put a par value on your shares. Don't put no par value. I feel like we've gone down a rabbit hole. I'm sorry, everyone. Par value is a minimum price for the stock that's mandated by law. You build it into your articles or your certificate of incorporation that says this is the very lowest amount we can accept for this stock. If you put 0, Nevada will deem it to be $1. If you put 0.0001, Nevada or Delaware will say, yeah, par value is 0.000001, however many zeros you want. That means when you're calculating your franchise taxes, which we won't talk anymore about, but know that that's important, the price is lower. But also, the price you're going to pay for your shares when you form the company will be lower as well, because you'll pay the lowest possible amount because the company has no value. So set a low par value, pay that amount. The company then will have a right for the unvested shares to repurchase them at that price. After 1 year, again, we put a 1-year cliff, 25% of my stock, so 25 shares will become mine, and the company no longer has a right to repurchase them. Monthly thereafter, 1/36 of my shares will vest, and I will get it, and then the company no longer has the right to repurchase it until all 4 years are full, and then I get it all. It's great because if you don't, when you go to finance your company the first time, your investors are going to come to you and say, we need assurances you're not going to leave the company tomorrow. We're going to impose vesting on your shares. So just start with vesting, and then it's not a problem. So what is an 83B election? I don't know if anyone has heard about this. It's an important thing. And I'm saying this in case you don't come to me and just have me form your company, or if you don't talk to if a lawyer doesn't mention it to you, you should ask about it. 83B elections are an election you can make at a tax level to say, I want to be taxed on my stock in full amount on the day I purchase it. Otherwise, at each time at which one of those shares vests and the company loses its right to repurchase it, I owe the US government tax on that amount. So if it's 25% and the fair market value is now $1, I owe $25 of tax. If the fair market value becomes $200 per share and I get 25 shares that vest, I now owe a corresponding amount of tax. So file your 83B elections. You have 30 days from the date you purchase your shares. Send in the election to the IRS. Send a self-addressed envelope and ask for that you put a stamp on. Ask them to send you back a copy. Everybody wins. Just formalize it. Just talk it through. Make sure you know what's going on. Granting stock with vesting to board advisors and key personnel with stock compensation. Sure. You should actually, and that's good. We're almost to the end.
Ryan, maybe if I can just jump in. We often get the question that a company starting out, they have someone that would be willing to serve as a board of director or on the advisory board. They would like to do some compensation or maybe even an interim business development person, but they're afraid that person might leave the company. So if you could comment also granting stocks to those folks, but with a vesting schedule so that when they leave, they don't get the full vesting if they leave, before a year.
Absolutely. There are two, again, granting stock versus granting options. If you're going to start bringing on employees, you should have someone establish an equity incentive pool for you, and you can start issuing options. If you haven't raised money yet, and the price of your stock is still very low, near par value, then issuing stock is a good option. To Grace's point, if you're granting stock in lieu of compensation to an advisor, typically it should never be more than 0.1% of the company, unless they're really adding value in a meaningful way. At most 0.5% in the earliest stages. Vesting is crucial for these people, but 4 years may not be the right term. You should think through for those individuals, how long will they meaningfully be adding value to the company? And so how long do I want to keep them incentivized to stick around? If I'm bringing on an advisor that I think I'll use for a year, then maybe I only need a year of vesting to keep them incentivized and keep them around. If I think I'll need them for 2 years, maybe 2 years of vesting. If it doesn't work out, and this is the reason why I recommend putting a cliff on shares, on vesting. If you hire someone and you have a 1-year cliff, but it turns out in the first 3 months, you realize this person's really not going to work out. When you terminate them, the cliff will not have occurred and they will have vested in no shares. So that first year, remember 25% vested at the end of the first year. Anything during that first year, if they're terminated or they leave, they get nothing. So building in a cliff can be a very useful term. Think of it like a probationary period for an employee. Vesting can be structured in any number of ways, and you can be really creative if you'd like to be. That's not expensive. Structuring creative vesting schedules is not expensive from a legal perspective. It's easy to do. But really think through, how long do I need this person? And how long will I need to determine whether they're actually going to add value? and assume that you will need a period to determine whether they're going to add value or not, because you do. As a pessimistic lawyer, you do, even if you don't think you do. I'm going to go a little quickly so I have time for more questions at the end here. But employment, and again, that's not so much what we're talking about here, but employment is important. Make sure you write down whatever agreements you're giving with people so that people don't get confused. If you're going to be sued during the life of your company, it will be because of an employment issue. You will all be sued at some point by a former employee. It's going to happen. It always happens. If you need any documentation, if you need an NDA, if you need an advisor agreement, if you need an offer letter, go to cooleygo.com and just use our templates. They're free. You can automatically generate them. You'll have a very high quality agreement that will protect you, and you don't need to do as much Googling. You don't need an employee handbook until you're really hiring employees, but then you do. And you don't need to pay a lot of money for it. Just go on to any Secretary of State of any state's website, and they'll have a sample you can use. I'm not going to spend a lot of time on this because we're running out. Independent contractors aren't employees. Don't get them mixed up. It's the most common way to owe more money than you think you do when you get sued after they quit, which they will. More independent contractor information. So questions, here are my list of references for you. They are all links to Cooley Go articles. That's intentional. Cooley Go is our online system that tries to put me out of a job. Essentially, it's a great set of easy, short, digestible information on any number of topics. Here are everything we've talked about. Here are just some great references. And it's really, really, I can't say enough about how great it is. And how much easier it makes my life when I can just tell people to go read this article. Okay, that's all I have for my slides. So I think we've got 5 more minutes. If anybody has any questions, anything they wanted to go back and talk about, anything at all.
Yeah, Ryan, let me ask a question about conversion from LLC to C Corp. We have a number of startups here in Reno that formed as a Nevada LLC. And then they realized they really need a C Corp, but perhaps a Delaware C Corp to go out for investment. And how complicated it is to go from a Nevada LLC to a Delaware C Corp?
It's not that complicated. Delaware law permits the conversion of a foreign entity into a state, so a Delaware entity. So we can still even use the conversion function to make that happen. Again, the most complicated part of the conversion is not the documentation. It's time consuming and it takes some work. The complicated part is how many stockholders or members you have that need to be alerted, because that'll depend how many votes you need to get. It'll determine how much information you need to give. So really, if you think you're going to do that, just keep your LLC as small as possible. Try to be a sole member or a single member LLC. That's much more helpful.
Thank you. And the other question we often get from entrepreneurs is what should go into a founder's agreement? Because a lot of entrepreneur has a co-founder.
So this is not the answer that anyone's going to want. Don't make a founder's agreement. You don't need one. Unless you're in an LLC. If you're in an LLC, your operating agreement will serve as your founder's agreement. It will determine who's going to get what distribution amounts, who owns what percentage, who needs to put more money in when they need to put it in, who has the ability to say yes or no on any major decision. Otherwise, if you're in a corporation, corporate law will specify who needs to approve what. If you're concerned about sharing control, put both of you on the board of directors. With a 2-member board of directors, you're essentially in deadlock unless you make a decision. Now, you will be tempted to be 50-50 founders. Please don't be 50-50 founders. Put somebody in control. Somebody has to be in charge. Nobody listens to me, and I have plenty of companies with 50-50 founders. I'm doing an investment right now into a company that has 50-50 founders, and it's creating a lot of strife as they decide what to do. They're going to get this great valuation on this round. One of them wants to sell a little bit to the investors in a secondary sale, but in doing so will blow the 50-50 control structure. The deadlock will be gone, and he would now be subject. He would no longer be in control of the common stock. Just decide early on who's going to be in control, and you'll be happier. Is it better to state that a disregarded LLC or change with filing 8832 for applying for grants? That will depend on the grant. Yeah, I can't weigh in anymore on that. It depends heavily on what type of grant you're applying for, how you're applying, and in general, they probably won't care because the name they will see will be an entity. It'll be the LLC's name. They won't know that you're a disregarded entity unless you specify so in either the diligence, the materials you're giving them, or if you otherwise tell them. An LLC will look like an LLC.
There's a question from Duke. If an LLC should sell IP assets and a simple majority is susceptible, is this a major potential legal battle?
That's a great question. Anytime you sell assets, there's always a legal battle, whether you like it or not, unless everybody's on the same page. If a simple majority is acceptable within the LLC and the operating agreement, then even if there is a legal battle, it doesn't matter. That is the beauty of the operating agreement and the beauty of corporate law. Once you've decided who's in charge, and once you've decided what approvals are required, it's very difficult to dispute that. Simply because you've decided already in advance what the contractual arrangement will be, either by default, because it's just what the law says, or because you've actually signed something. So I wouldn't think it would be a big issue.
Great, we're coming up at 2 o'clock. I want to thank everyone for joining, and thank you, Ryan, for the really informative webinar. I have listed the Cooley link for everyone, and if you have a burning question, I'm going to say you can email Brian. And again, this could be one of the first of a series of webinar that we're going to devote to corporate entity financing and all those topics that are important to starting a company. Again, thanks everyone for joining, and please sign up for our newsletter so you can be informed of future events.